Good afternoon. Welcome to our webinar today. Today, we're going to take a look at some of the changes we have seen in the economy and labor market 3 years after COVID originally sent us home from our offices for what was supposed to be 2 weeks in March of 2020. My name is Kevin Miller. I'm the Vice President of Marketing and Sales here at Chmura and will be your host for the day. Before we get started, I do have a few housekeeping items to quickly go over. We'll go ahead and send out an email soon with a link to a recording of the webinar and a link to download the slides. So just keep an eye out for that. I think we'll probably post the link on social media as well, either today or tomorrow, probably tomorrow. During the webinar, please go ahead and ask questions. We highly encourage participation with questions. That always seems to drive a lot of good conversations towards the end. So go ahead, as we're speaking, go ahead and put the questions in the chat at any point during the webinar, and we'll try to get to as many of those as we can towards the end. Just one thing, if you do see your question disappear from the chat, in some cases, I just go ahead and move those into the Q&A tab just so I can keep better track on the things that we do want to ask. So don't worry, the questions are still there. They've just been organized differently. So with all that said, we'll go ahead and get started. So our speakers today are going to be Dr. Chris Chmura, the founder, CEO, and chief economist of Chmura Economics and Analytics, and Patrick Clapp, who's on our consulting team, a senior economic consultant here at Chmura. For those of you who are new to our webinars, we do like to start with a quick overview of who we are as a company and what it is that we actually do. So as a company, we provide labor market data and analysis through three main offerings: our Jobs EQ software, our consulting services, and access to the data that we have in the Jobs EQ platform. We were founded in 1998 by Chris, who will be speaking with us today. We have offices in Richmond, Virginia, and Cleveland, Ohio, but do serve hundreds of clients all over the country. Our employees are economists, data scientists, statisticians, and general business professionals who really every day we come to work with the thought and the care of helping our clients get access to the data they need to help grow their communities and organizations, really to give that data to make informed decisions on their end. Which this leads us to what really drives us as a company, which is complete client satisfaction and being a main contributor to their success. Excellence is what guides us as a principle and is always what we strive for in customer service and data quality. One of the things that we are really proud of as a company is that we often hear from clients about how these two things really differentiate us from similar products that you see in the market. In addition to excellence, the three other ideals that we adhere to are being thorough and accurate with our data and making sure that our offerings are useful to our clients, and really that we are always serving their needs with our products and services. As a company, the primary markets we serve are on the corporate side with talent acquisition and human resources, economic development, education, site selection, staffing, and workforce. And kind of getting into those, looking at those verticals, this is just kind of an overall snapshot of those clients that we do serve. You can see here it just ranges from major corporate clients through 2-year and 4-year educational institutions to public sector clients in economic development and workforce. So really the type of data that we have and the service we provide really go to a large number of different types of organizations. So with that said, I'm going to go ahead and turn it over to Chris.
Great. Thanks for that background, Kevin. One of the things that we do offer for our clients and even those who aren't clients is this complimentary weekly economic update. And especially during these times of uncertainty, I think it's useful to see the data that are coming out next week that came out the prior week, and then a little overview of what those numbers mean for the economy. The Federal Reserve is very important now in terms of what they're saying about interest rates going up. And then we give you an interest rate forecast and some of the financial numbers. So if you'd like to sign up for that, please click on this link here and do that. And it comes out every weekend. So the economy 3 years after COVID-19. What we're going to do first is go over a high-level timeline of when COVID occurred, how it impacted the economy. Then we'll look a little deeper about the COVID recession. What did it look like? Was it expected? You heard Kevin say that we all at the beginning thought it was going to last just 3 months. Will the upcoming recession be any different than what we saw during COVID? We'll talk a little bit about the future of remote and hybrid jobs. And then Patrick will talk to us about workforce impacts that varied by demographics. So with that first high-level COVID overview, going back here at the start in March 15th, I mean, this was totally unexpected, the pandemic that came upon us. The economy was really strong when we went into it. We were just coming off the longest expansion in our entire history. The unemployment rate was a low 3.5%. In March, it jumped up to 4.4%. So then we move on to just a couple of days within the states being shutting down, and California was the first to implement stay-at-home order. And again, employment growth here at the bottom slowed quite quickly, or stalled quite quickly. February 2020, it was up 1.5% from a year ago. By the time we got just 1 month later, it was only up 0.4% from a year ago. Congress acted very quickly to try to save the economy from going into what potentially could be a depression or even worse. And we saw the CARES Act, the PPP, stimulus checks, expanded unemployment benefits signed. I don't know that we've ever seen Congress act so quickly. And then in early April, we started to see the mask mandates, CDC releasing information on wearing masks. And then in April, the unemployment rate skyrocketed to 14.7%, and that turned out to be the peak over the COVID recession. In April, we started getting the stimulus checks from the IRS, and the economy was continuing to tank. The manufacturing sector plummeted to down 19.4% from a year ago, and in just 3 previous months, it had been growing fairly well. In April 30th, the Trump administration launched the Operation Warp Speed to try to get vaccines as quickly as possible, which in the past historically have taken 5 years or even longer to create a vaccine. All of the stimulus money was coming into the economy and really helping out households. In February of 2020, the savings rate was fairly high at 9.3%. But when the households started getting all of their money, it skyrocketed to 33.8% savings rate. That's extremely high. So in summary of this first part of the timeline, we saw a massive drop-off in the economy because of the pandemic that came upon us very quickly. Now going to the second half here, you can really see how we were whipsawed with the economy dropping off and then coming back fairly quickly. In December of 2020, in record time, we had a vaccine, which was great news. The unemployment rate was dropping. It dropped by more than half from its peak. By December of 2020, it was down to 6.7%. In March, the CDC recommended that people that were fully vaccinated could interact indoors with other people without masks or social distancing. So now we're getting to a point where the economy can open back up and more businesses can open up that were closed on a mandatory basis previously. So consumers felt confident getting back into the economy, and you could see that from these consumer spending numbers. They also felt a little better about getting back into the economy, and they had that stimulus money to spend. So in April 2020, we saw spending up 115% from a year ago, which is extremely strong. But a year later in 2021, it was up 30%. And that is also very strong, not as much as the year ago, but 30% is something that is a very good spending rate. So now we get to March 31, and the Biden administration signed the American Rescue Plan Act, which added additional stimulus checks to households and helped businesses. This, along with the continued Fed accommodations, was creating perhaps too much money in the economy. And we'll see the impact of, and we're living through the impact of that right now. In terms of employment, we were still at the lowest point. We were 21.9 million off the pre-COVID peak. By April of 21, we're still 7.8 million below the pre-COVID peak. So employment is coming back, but still we're not at previous record levels. In July 2021, the Delta variant emerged, and so that caused more concerns about the impact on the economy, and we took sort of a step back there. The labor force participation fell when COVID first started, which made sense, but it continued to remain stubbornly low. So pre-COVID, 63.3%. July of 2021, it was only up to 61.8%. And Patrick will give you more background and flavor on that by demographics in the second half of this presentation. March 2022, Hawaii becomes the last state to lift indoor mask mandates. Then to bring us further forward here, the change in the CPI, it's clear that we have an inflation problem because of all the stimulus from the federal government as well as the Federal Reserve. The CPI peaked at 8.9% in terms of inflation, and in March it had only fallen to 5%. Great progress, but still not low enough. The Fed is targeting a 2% rate for the best functioning of this economy. So let's go back to the very first webinar we did during the pandemic, and this was April 15th. And at that time, and this was not just us, it was just about everyone saying, oh, COVID-19 is going to last 3 months, maybe through May. And let's go with the second scenario. It lasts 6 months through August. Then we had a third scenario with businesses sheltering in place more so than before. Here's a pull out from one of our weekly economic updates at the time, a quote from Federal Reserve Chair Jerome Powell saying, there is nothing fundamentally wrong with our economy. We went into this COVID recession with a very strong economy. From that perspective, we all expected to see a slowdown, but then a fairly good rebound. So this is what it looked like when we were talking to you early in April and gave our forecast. So we got this right. It was going to be sharp, short, and not sustained. This is real GDP, the broadest indicator of economic activity. The forecast here, this was the first quarter where the recession took place in 2020, the second quarter, and then here we show the rebound. And these numbers in terms of the rebound, that is the out years of the rebound, those we got fairly correct. However, what we didn't get correct is the magnitude of the decline, and also the quarters were switched. So instead of having almost 15% decline in the first quarter of 2020, we only had a 5.1% decline. And then in the second quarter, instead of it only declining 5%, it was 31%. It was off the charts. And then the same with the rebound. The first quarter of rebound, it was up 33%, way off the charts. And again, though, the next following months, we did get that correct in terms of the forecast. So now let's fast forward here a bit to just about a month later. We had a lot more information in June the 4th for our presentation. And as an economist, we had to learn a lot. Well, we did learn a lot more about vaccines and spreading diseases than we ever did before. And that was the driving portion of our forecast. It wasn't anything related to interest rates or relative demand from consumers. It was because of the pandemic, but our models were not working like they typically do. It was all medical driven. So here we talked about the national economy as two stages. You have the supply shock, and this is where non-essential businesses closed and citizens were asked to stay at home. And so clearly there was nothing to go out and buy unless it was essential. Then we had the demand shock, stage two. And then, so the demand shock is when the restrictions are lifted, there is still some social distancing, and we have strong demand. That's what we call the second one, this demand shock. And at this point in June, we were looking at a forecast where the vaccine comes first quarter 2022. No one thought it could be in the fourth quarter of 2021 or in December. We did have an alternative, though, where we assumed it was in 2022 is when we thought we'd have the first vaccine, which was more than a year out. The alternative was as early as 2021. No one expected it to come out in December of 2020. So the forecasts, again, were all being driven by medical information, vaccines, etc., rather than our typical models that we run. So based on whether or not these industries could social distance, whether they were essential businesses, and whether they had the ability to work from home, we looked at all these industries at a very detailed level. For example, in manufacturing, or maybe let me use retail as an example. In retail, we looked at the forecast at the level of grocery stores versus department stores versus clothing stores, and they all had different information with regard to working from home, social distancing, etc., and whether they were essential. So once we did a forecast at that detailed level, we summed it up to get to this level, a major level. And based on that information, we did quite a remarkable job in modeling when the industries, how much employment would drop off. So here, pre-COVID, we're starting at 100% of what employment was. Then here we predicted, for example, in this industry, arts and entertainment, employment dropping off by 80%. And then we have employment coming back before it reaches the pre-COVID high. And we use this information to put in Jobs EQ because we have a forecast. And we knew that if we use the current forecast, it would be totally wrong for those people who were trying to determine how who was losing their job in the region, who needed support in terms of employees. And we did quite a bit of consulting work at the time too, to help industries or regions look at their overall workforce. And then here is a map that we created by county using that same information about the sectors and where you would see the greatest losses to show how vulnerable those counties were to potential losses. So you can see where we're along the coastline, where there's a lot of entertainment, a lot of tourism that wasn't happening during COVID at the beginning of it. That's where the greatest losses were, as opposed to the heartland of the country, where we're looking at more farms and other industries where social distancing was not as important. So we learned a lot during COVID-19, but a couple of the things I think we learned about the U.S. economy, it has always been true, but when we went through COVID, it was magnified that we saw these attributes that we're always seeing in the economy. And one is, if you all took economics in 101, you learn about the invisible hand that Adam Smith talked about, where we as businesses or as people create products to help ourselves, but also it helps society overall. And that was very evident during COVID. Zoom, remember GoToMeeting? Zoom eclipsed GoToMeeting to allow us to have face-to-face sales and business meetings. We had in-person conferences that morphed to webinars with software like Webinar Jam, which we're using right now. Peloton replaced gyms. And then here's just one example of what many companies did. GM shifted to producing face masks to the degree that they were making 1.5 million per month. We saw a lot of flexibility and innovation in our economy. A vaccine in 1 year, distilleries making hand sanitizer, curbside pickup and delivery at grocery stores, and perhaps one of my favorites, carry out margaritas, which I think in some states they still have. In any case, again, these are things we always see in our economy, but during COVID, it really showed itself more as if it were magnified and happening more quickly. So how will the next recession differ? Here on the left side, we have the COVID-19 recession. There was a sharp drop in spending, and it was because the government enforced the stay-at-home policy. We had supply chain issues because of a lot of the lockdowns. We didn't have as much coming from overseas because of different countries having greater issues. We go ahead to what we expect to see a recession in the second half of this year, and we only expect a modest reduction in spending, with the unemployment rate only going up to 5 to 6% as opposed to the double digit during COVID. inflation is reducing spending power as opposed to the COVID recession, where there was plenty of cash because of the stimulus from the federal government and the Federal Reserve accommodation. But in the recession in 2023 that we're expecting, the yield curve has inverted. Banks have been having to increase their yields to get deposits, so they have less money available to loan out for loans. So credit is getting tighter. Commercial real estate, where we don't have as many people working at offices, we may end up seeing loan issues, which will make it even more difficult in the banking industry. Back to the COVID-19 recession, most impacted industries were those that couldn't social distance. The COVID, though, also on the positive side, helped see positive gains in some of the industries such as Zoom, Peloton, casual clothing, because we only saw the top half of what people were wearing when they were on their Zoom calls. Housing grew significantly because of people moving outside of the cities, and warehouses and distribution. We saw tremendous growth there. But in the 2023 recession, more like a typical recession, except for that industries that ramped up very rapidly, like these here, are now seeing some drop off in employment. A lot of the IT companies were hiring quickly in the last couple of years and now are laying off. Commercial real estate, we may see some issues there because of working from home. And then again, that would ripple to the banking industry. Whenever you see higher interest rates, which we're seeing right now, you see less capital investment by businesses and also less spending on durable goods by households such as cars or refrigerators. And then housing sector has been slowing, but part of the issue there seems to be there's not enough inventory. So we may see housing continue to grow a bit just because of the inventory issues that we're seeing. And one other positive or exception to the industry impacts is the semiconductor producers, because of the CHIPS Act and the reshoring will likely cause some industries such as pharmaceuticals to outperform during this upcoming recession. So as we look at our forecast now, here you can see the actual recession from COVID, the Great Recession that occurred previous to it, and now our forecast. This number actually, first quarter came in today. Our forecast was for about 0.9%, and it came in at 1.1%. Here we expect second quarter to be positive, and then third and fourth quarter to show mild declines, and then back in 2024 to start to grow again. This forecast is dependent greatly on inflation and whether the Fed is able to bring down inflation quickly or whether they have to keep rates higher for a longer period of time. The higher inflation stays, the longer and the worse we would expect this recession to be. So now to remote work. Is it here to stay? So let's look at some data with regard to that. And this is a survey that the Bureau of Labor Statistics has been doing over time. And it says here, you can look at it by ethnicity, but that's not on this chart here. If you go to the site, you can look at that. But the operative word here is the percent who are teleworking due to the COVID-19 pandemic. So it may be that some people are still teleworking today, but if it's not due to the COVID-19 pandemic, then they're answering no to this question. So at the beginning of COVID, when they started this anyway, in May of 2020, almost 40% of women, about 36% of all people were teleworking because of the pandemic, and that has come down. And right now the numbers are around 7% or so. Again, the operative word being it's because of the pandemic that they're working from home. But some people are working from home because policies are now allowing them to do so from the companies that they're working at. So this is this comes out of Jobs EQ. It's our RTI job postings. We spider over 45,000 or so sites on a daily basis, deduplicate it, and then provide it to our clients. But at the top in blue, you're seeing the number of job ads that note the possibility of remote work in the U.S., and in gray, you're looking at those from last year. So one thing, well, first of all, currently 6% of all job ads talk about the possibility of remote work. So 6%, much less than you would think based on some of the things that the media has been saying. If we go back here to June, July time period, we saw a peak number of 340,000 out of job ads where they're being allowed to work from home. And now we're looking at something where around 290,000. So the number of ads allowing work from home has been dropping off. And then down here, you see the main occupations that are allowing, the top 10 occupations that are allowing remote work. And notice that 4 of them are IT related: software, computer and information, computer systems engineers, computer user support specialists, as those most likely to be working at home. Accountants and auditors here at the bottom, customer service rep, also among the top 10 list. So we've started now seeing some articles, anecdotal evidence, and other information about a shift away from work from home. There was an article in Wall Street Journal not too long ago about the option to work from home disappears for millions. This is an interesting article if you want to look it up, because it shows it by industry. So the option to work from home varies by industry. So first we have this BLS survey, and that's the one where they have the information by industry, where here's the percentage of establishments saying employees teleworked rarely or not at all. Pre-COVID, 76% of establishments said that employees rarely teleworked. That fell to 60.1% in 2021, and 72.5% it rose to in 2022. National Bureau of Economic Research did a survey about the number of employees working fully on site. In November 2021, it was 54.6. More recently, in February of 2023, it was up to 60.8. So again, much higher, I think, than you would think. And then Robert Half, from that same article, did a survey and found that 92% of managers preferred their teams to work on site. And the reason for that is because of innovation, creativity, and collaboration can suffer if they're not on site. And that it was important for mentoring and training new and existing employees. And that's something that we heard questioned early on during the pandemic, whether these would become issues that ultimately cause managers to have individuals come back to work. And then another article in the Wall Street Journal early in March wasn't specifically about work, but research about face-to-face interactions are important. And the American Friendship Project, this is a group that started early during the pandemic. They surveyed a little over 3,100 individuals between August and October of 2021. 50% said that they lost touch with a friend in 21-22. 44% said they missed out on making friends because of the pandemic, and 34% were unsatisfied with the amount of time they typically spent with their friends. So clearly, again, another sign of the importance of meeting in person. And then one other thing that, along with the workforce working from home question, is the question about workers leaving big cities. Again, going to the Wall Street Journal, there was an interesting article at the end of last month showing population changes by the largest 25 MSAs. And so you can see here on the right-hand side, a lot of the MSAs saw fairly good increases. This is from the census data over this period going on down. But we also had some other large metro areas that saw a decline, but notice these declines aren't dramatic. They're all less than 1%. San Francisco, Detroit, Baltimore, St. Louis, and Portland, Oregon. Some of the other things that they found high level is that the core counties of these large MSAs saw a net loss of 800,000. So that would be like New York City. However, it was the suburbs of those MSAs that received most of the growth. So that net loss of 800,000, most of it went to the suburbs surrounding those core counties. And then the rural areas and small towns collectively were flat. Some of them obviously benefited, but overall, if we sum them all up, they were flat. So with that, let me turn this over to Patrick to give you a little more detail on remote work and also about participation rates before we open it up to questions.
Thanks, Chris. It's so interesting looking back at everything that's changed over the past 3 years of the pandemic and remembering all of this information kind of trickling in. The information that we got with some distorted or difficult to read signals on what these impacts were. And it's a good opportunity here to take a look back and see how many of those initial trends are continuing to today. I want to talk a little bit more about remote work and continue that conversation. I saw some very relevant questions in the chat already that I can touch on here. And then move on to some of those pandemic impacts, looking particularly at the labor force participation rate from a few different angles to see who was impacted and what the recovery and expansion looks like. So first on remote jobs, this is another view similar to what Chris was talking about just a few slides ago on remote work. And because of the difference, I think she said it was only about 6% of total ads. The difference in magnitude, I've got two different axes on this chart. So the left side, we're looking at total ads measured in millions of job ads. On the right, we're looking at ads that are mention remote work as an option, measured in thousands here. This putting them together this way on the chart does help highlight a couple different trends in a different way of looking at things here. In the early days of the pandemic, you can see a really sharp drop in online job ads as the country shut down. Job ads are typically we look at as a leading indicator. It may not ultimately result in hiring, but it's a good indication that employers are looking to hire and hire soon. So when we see that sharp drop off, that's consistent with a lot of the uncertainty that employers are facing around hiring and what the pandemic might mean. During that same period, we start seeing that initial rise in remote job ads. So even as ads are falling generally across the nation, the rise of remote work is starting to show up in job ads. So this is related to what Chris was showing earlier in that period where 30 to 40% of workers were working remotely. But it's showing up as a much smaller percentage here because again, we're looking at new job ads for new positions. But we start seeing remote work become mentioned more of a discussion, more of something that employers are offering to entice workers. How does that look today? If we continue the chart, we can see remote work continued to rise very quickly and steadily into about the middle point of 2022. At about that time, we start to, as Chris mentioned, look at some of the concerns around inflation, at the possible slowdown of the economy, and job ads in total and for remote work start to fall off. Interestingly, since about the midpoint of 2022, the two lines have been pretty close together. And without reading too much into the possible correlation here, it does look like remote work, at least for some percentage of the jobs, is now tracking along with the overall trend in total jobs. So there's some, to some extent, remote work has been adopted and ingrained as a part of the total job ads. But as along with the other trends that we're seeing in slowing down, both remote work and total ads are down about 13% year over year, ending in March of this year. The question that I mentioned, I think it was Stephanie, asked about hybrid work, and excellent timing. We don't have as robust of a measure of hybrid work within Jobs EQ, but we do have a very strong keyword search option to build custom searches of ads in the real-time job postings. So I did a quick search here for hybrid work, removing a couple other keywords that are related but not really, or that include hybrid but not really related to this interest. And it's an even smaller percentage of ads that specifically are mentioning hybrid in this keyword search. It's about, if remote work was about 6% of the total number of ads, hybrid is just under 4% as of April this year, earlier this week. Interestingly, though, we've seen the decline in total job postings and remote job postings in recent months and over the last year. Hybrid work, admittedly a small percentage of the ads here, has actually been growing over this time. And that's something we'll be continuing to look out for as a possible long-term balance of the remote work with some in-person, some of the benefits of in-person work. Of course, that has some significant implications for commercial real estate. If the trend is indeed headed towards more hybrid work, you might expect more of a return to some of the employment centers pre-pandemic, and fewer options for hiring workers anywhere around the country for full-time remote. And the hybrid work jobs are shown at the bottom here underneath the trend line. And you can see a lot of the same ones that Chris was showing earlier for remote work. So it's even within these same occupations, largely IT, some sales, and accounting as well. I want to turn next to some discussion of the labor force, and maybe something we haven't checked in on in a little bit, the civilian labor force, which is the number of people ages 16 and older, number of civilians 16 and older who are either employed or unemployed and recently looking for work. As the population has continued to grow and more people are coming back into the labor force, the civilian labor force has actually surpassed the pre-pandemic levels. As of March of this year, there are over 2 million more workers employed or unemployed and looking for work than there were in February prior to the start of the pandemic. That it was a tight labor market prior to the pandemic. If you remember some of the statements about there's nothing fundamentally wrong with the economy, there were discussions of difficulty finding workers and filling jobs prior to the pandemic, which has only heightened a lot of the ability of to fill jobs, and since that point. And when we look at the labor force participation rate, actually, we're still looking at below pre-pandemic levels. The level is the rate is just above 62.5%, even with some recent increases, but that's remaining about 0.7 percentage points below the pre-pandemic. And the journey of that sharp drop in participation rate at the start of the pandemic, recovery pretty quickly, but not fully, and the path that it's taken really gets pretty interesting as we look at some of the breakouts of who is impacted. And before I move on, I just saw a question come in from Rory to redefine and reiterate the civilian labor force is people who are working and those who are unemployed, defined as they are actively looking for work. So I have included I've blocked part of the chart here to take us back to some of the early days of the pandemic. And even this data was not coming in at real time. We had to wait several months and quarters, sometimes longer, to get some of these data to come out. When we break it up by gender, women faced a higher rate of dropping out of the labor force and a slower recovery. So women are shown in green on the chart here, and we're looking at a percentage point change in labor force participation rate relative to February 2020. So 0 would be returning to that pre-pandemic level. It's reasonable to assume that women would continue to face the greater impact than men throughout the pandemic recovery. And we've in fact done several presentations and webinars on this as we look at how the data actually progressed. Indeed, for much of the history, you see female labor force participation recover at a slower pace and below that of men. But interestingly, in the latest data, so far in 2023, female labor force participation rate actually seems to be inching up a little bit faster in recovery than for men. Still both below the pre-pandemic level, but a shift actually in some of the early trends from the pandemic. And I think a positive result for all of the attention paid to some of the additional difficulties that women were facing in returning to the labor force, particularly around things like childcare and other care for family members, and some of the industries that they're working in that were severely impacted. We can also break this out by race and ethnicity. So here, the Hispanic population is broken out completely separately. So you should read the other breakouts as, for example, white non-Hispanic, black non-Hispanic, which is a little bit different than how some other data are broken out. But in the early stage of the pandemic, Hispanic and black and Asian populations were impacted at a much higher rate than in labor force participation than were white workers. How has that held up? The Asian and black population labor force participation rate has actually risen above pre-pandemic levels as of a few times, but in particular in the most recent data. So at the continuing to remain below the pre-pandemic levels, white and Hispanic workers are now among the lowest remaining participation rates. We can also break this up by race and ethnicity and gender. So this chart's going to focus only on women who we saw earlier faced greater impact. And in early studies, we saw that Hispanic and Black women in particular faced even greater impacts on the labor force participation rate shock. It took the hardest hit during the initial phase of the pandemic. How are things progressing? Asian women are recovered and well above pre-pandemic levels. And the other remaining groups here that we've broken out are pretty close together from the initial separation in shock. White, Hispanic, and Black women are all just about a percentage point or so below, or 10 percentage points below the previous labor force participation rates here. We also took a look early on at some of the expected rates impacts by educational attainment. Many of the jobs which could be performed remotely and might insulate workers from some of the shock of the shutdowns and social distancing require a bachelor's degree or higher. So we'd expect workers with a bachelor's or higher to face less of an impact, and lower education workers to bear more of the brunt. And indeed, we see high school, some college with no degree, and less than high school workers are facing the steepest declines at the start of the pandemic. Since then, the green here is less than high school, and is a good reminder of the population that we're looking at. We're looking at the civilian population 16 years and older, so this includes a lot of young adults who are in school, and explains some of the seasonal patterns that we see in June, July, August, as they are out of school and taking on summer jobs. But seeing sharper recovery and growth than we might have expected out of this group. The lower groups here, actually associate's degrees, interestingly, individuals with an associate degree or with just a high school diploma are at the lowest point from their pre-pandemic levels. That's the latest data. And I've spoken a little bit about age, but in previous recessions, younger workers have often faced the brunt of the job losses. And so we might reasonably expect at the beginning of the pandemic to see some of these initial impacts of 16 to 19-year-olds and 20 to 24-year-olds dropping out of the labor force. You can already see some of the initial bounce back of 16 to 19-year-olds, even in summer months of 2020, because of that seasonal pattern. And I've added a trend line to show some of that difference and smooth some of that out, that the young workers, especially 16 to 19-year-old, are able to fill some of these lower skilled job openings and have been surprisingly able to bounce back from a lot of the initial impacts of the pandemic. Ages 55 and over who are at retirement or approaching are in purple. It's a little bit hard to see, but at the very end, you can see they're at the furthest distance away from the pre-pandemic rates, which you might expect with a possible increase in retirements and less interested. The possible health concerns of returning to in-person work. Did we indeed see some increased retirements due to the pandemic? Social Security tracks the retirement applications on a recurring basis. And going into 2020, we saw a pretty steady increase with the aging population and retirements. I was a little bit surprised to see this actually leveled off in 2020 and 2021, even while workers who were potentially eligible for retirement were maybe dropping out of the labor force or not looking for work, weren't necessarily filing for retirement. Some of the additional support from things like federal stimulus programs or savings that they might have had could help bolster them through this uncertain time. As things have continued to develop and clarify, and what the COVID recovery looks like has become more clear. We have actually seen a surge in 2022 in retirements, well above the previous trend, maybe making up for some of those 2021 missed retirements. This, of course, has implications with the replacing workers, especially in industries with a large number of workers who are at or nearing retirement, and something that we'll continue to look out for as a development in the labor market here. With that, I will turn it back to Chris to wrap us up.
Great. Thanks, Patrick. So 3 years after COVID-19 started, has the pandemic changed the labor market for good? I think in some ways, clearly it has. We're seeing more work from home. But will it be always as high as what we're seeing now? I'd say it's too soon to give a definitive answer to that. Recessions always accelerate trends. So what we saw during COVID, the work from home, the early retirement, but this last recession, driven by the pandemic, really complicated things and made it something that we've never seen before. So, so from my view, some of those trends that we think may be more permanent, I think are going to come back closer to what we saw previous to the pandemic, but certainly work from home, not totally all the way back. The upcoming recession is going to be really important in terms of seeing how much things do shift back. And we're already starting to see the labor market shift toward an employer's advantage, whereas it was the employees who held the upper hand in the previous couple of years. Early forecasts allowed some quick mobilization of resources to help the impacted industries and citizens. And I showed you that on some of the charts where we were going to see the drop off by industry, by region. And again, we made that available in Jobs EQ and had some consulting studies that really helped some regions to consider how to help those most likely to lose their jobs. It's looking like 2020 was the peak for remote work. We're starting to see the percentages coming down. Some of those early trends in participation rates have continued to persist. Some of those have not persisted, and we've seen some trends, especially by gender and ethnicity, going back to pre-COVID levels. And then finally, early characteristics of recessions can vary greatly depending on uncontrollable external factors. So here, you know, when we look at our interest rate or our models for recession, higher interest rates lead to tighter credit, lead to durable goods being more expensive, so people buy less. And those are things that our model catches. What our model doesn't catch is those uncontrollable external factors, such as the Ukraine war. Will it continue on? Will it get worse? Will it end over the next couple of months or year? Oil prices. We have no control over oil prices. Will those continue to go up, or will we see them down? So there are clearly factors that can make this recession worse than our expectation, or even cause it not to happen at all. But at this point, I would put a 60 to 70% probability on us seeing a recession in the second half of this year. So with that, thank you for your questions, and let me turn this back to Kevin.
Yeah, thanks, Chris. I actually think that a lot of the questions that were asked, Patrick addressed during his presentation, which was great, about the hybrid work and some of the other things related to kind of the labor force participation rate. One thing that did get answered that I think he answered privately, Chris, but may be good for the good of the group because I know we have a lot of folks involved in higher ed here. But the question was, during many recessions, especially when unemployment rates increased, education providers often see an increase of individuals who return for additional training and education, which that didn't happen in the COVID recession. Do we think or anticipate that that might be a factor in this next recession coming on?
Yes, and that is absolutely true. We usually see that people go back to school, especially if they just got out of school, they can't find a job, they have a BS degree or an associate's degree, so they decide to go, if associates get a BS degree, or if a BS degree get a master's degree, because they can't find a job. And we didn't see that during COVID. And also, I would think we may see that a little bit during this upcoming recession, but not so much, just because the demographics are working against college enrollment. What I mean by that is we have slower population growth right now.
So I think that's about all we had. I think we got through all the other ones that were asked. So I think we can just turn it back over to you, Chris, to close this out.
Sure. There might have been one that we didn't fully explore, and that is the people coming back to offices. I mean, clearly we're seeing some of that, and it's more predominant in some industries than others, like finance and banking. Seems a larger percent are being required to come back. So anyway, the commercial real estate industry probably in some areas will suffer a bit. From some of the data in Florida, occupation rates are way back up, especially in some data I've seen from Miami. Never really did drop off much during the pandemic. So this is still very much a regional event. Even when you have recessions, they're regional because they impact different areas differently because of the industries that are in their region. So again, thank you for attending today. Thank you for, hopefully this glimpse of the last 3 years has been helpful to you. And please continue to reach out to us and let us know webinar topics that you would find useful for us to talk about in the future. Have a great afternoon.